Well, welcome back, my friends, to the Mail Right Real Estate Agent Podcast Show. This is episode 109, and I'm glad to be back. I missed you last week, and Jonathan did a great job taking over the show. And I want to introduce Jonathan in a minute, but first I want to get to our fantastic guest that we have. This gentleman is not only one of the #1 lenders in San Diego County, but happens to be a longtime networking partner and friend of mine. And I do most of my business with him, so I thought it was time to get a good mortgage expert on here and share some knowledge. Jason Gordon, say hello to our audience and maybe give us a quick introduction of yourself.
Will do. First of all, thanks for having me, and thanks in advance, folks, for your time and attention today. My name is Jason Gordon. I'm a branch manager and senior mortgage loan officer with Amerifirst Financial here in San Diego, with local offices in both Carmel Valley and Mission Valley. I spend about 90% of my workflow originating mortgage loans, about 10% managing a staff within my branch. And I'm also a registered speaker with the Performance School of Real Estate. So if my name looks familiar or I look familiar, you may see me speaking and doing workshops for you, either at your office or at the Career Compass Real Estate Seminar.
Awesome. And Jonathan, I want to let you introduce yourself and tell the folks a little about you.
Oh, hi there, folks. I'm the founder of Mail Right. It's a software service that helps you get more leads from Facebook and from email marketing. Back to you, Thomas.
Thank you, sir. And I'm Thomas J. Nelson. I'm a San Diego residential realtor where I'm never too busy for your referrals. And you can find me on my website at thomasjnelsonrealtor.com, or, of course, on social media. You'll find me mostly on Facebook and LinkedIn. All right. Well, this is long overdue, bud. I'm glad you're joining us today. You know, and I, for better or for worse, I always let people know, especially when I'm referring you, that the reason I refer you first and foremost is the way I met you, and that is as a lender. It's not because we're good friends, and so I throw all my business your way, because if you weren't able to deliver the goods, I wouldn't refer you. And so our friendship was born of a business relationship and a networking relationship that developed over years of helping clients and some challenging situations. We went through the Great Recession, the Great Depreciation of our market together. And unlike a lot that bailed and got out, you and I weathered the storm. And that was one of the things that solidified you as a professional that I go to now. And we had a nice friendship that came out of this relationship. But I want to start with some questions that for some may be a little basic. Others, this might be the first time they're hearing this. We'll go through some more advanced questions as we go. I want to first talk about one of the #1 questions I get from my clients, and that is, well, if I'm rate shopping or if I'm shopping lenders, because maybe I refer you to a client, but they still want to vet you out against other, you know, they want to go online and do that turbo mortgage or whatever, you know, all the non-relational ones. They get worried about multiple lenders pulling their credit. And can you speak on that? Like, at what point does that damage their credit, and how much leeway do the credit reporting agencies give people?
It's a great question. I appreciate you asking that. The reality is there's not a simple short answer. And I will often say it just depends really on the situation. So if you look at the algorithm that the credit bureaus use to create a score, the portion of the score that's actually going to be influenced by a credit inquiry is 10% of the weighted average. So it's a small portion of the overall weighted average. However, it really depends on how thick the credit profile is. When I say thick, it's more a reference to how many trade lines or active accounts are on the actual credit report that are reporting. The reality is somebody who has a thick, long credit history has a slightly smaller impact for a credit inquiry as opposed to somebody who really has no credit. So there's something to be said for kind of getting your experience with credit. It does have several benefits, including credit inquiries. But with that said, I would, no matter who you are, I would limit the credit inquiries to maybe 2 or 3 at the max, just to keep your scores in mind. Because it's not necessarily that you're going to get approved or not approved, but it could be a difference in your rate quote if you drop below certain benchmarks on your credit score. And those inquiries can be just enough to bring you down to the next credit tier, which could hurt your rate quote.
And I realize this might be subjective, but in general, what kind of a hit do you take? Like if I'm at 750 and I shop 5 lenders, what's the result of that on my credit score? What's it going to drop to on an average?
There's not really an agreed upon number to give you. I'd say with 5 inquiries, you're starting to venture into a danger zone. If I said 10 points, I wouldn't want to be quoted on that. Hey, it only moved 9, or hey, it moved 11.
Right.
Again, I'll defer to my previous answer, both in the 10% weighted average, as well as just limiting your credit inquiries to 2 or 3 at the max. And remember too, that direct lenders and brokers have the ability to use their credit report to shop around for you. So you don't have to get, when working with a direct lender, I can be shopping dozens of lenders with your one credit report, where if you went to some of these, and I won't say companies' names by names, but some of these,
a brick and mortar,
some of these companies that like to sell you as a lead to multiple lenders who all pull your credit upon receipt of your lead, you can click one button and have 5 or 6 credit inquiries, and that can really hurt.
Wow. Okay. Well, and that's the other advantage that I found working with you is, I have people that say, well, I'm going to go with my bank because I bank there and they're going to give me the best rate. And my thought is, well, based on what are you assessing this? And also, do you understand that they only have really one product to sell, their product, versus a broker like you that can go and shop all the banks for your clients and find the best rate, not just the best one within their wheelhouse?
Yeah. So the term that we use in the industry, we call these platforms. And so let's say you are a borrower, you're seeking to obtain a mortgage loan, and you want to find out how that money can be delivered on your behalf to escrow. You have 3 options. We'll call them A, B, and C. A, we'll just put all banks and credit unions into that one bucket. B, we'll just use for brokers, B for brokers, and then C, we'll use for direct lenders. I've worked for each of these platforms, so I can speak, firsthand as to the pros and cons. And I want to start by saying that I'm not looking to disparage any other competitors when I say this, but most of us begin our careers in platform A, in a bank or a credit union. They're pretty easy to be hired into. They give you great training. Everyone recognizes the logo on your business card. You get that warm, fuzzy feeling that people are already in your lobby. And they walk over across the lobby to your desk, and they sit down and apply for a loan. The challenge is, when I worked for one of those banks, and I won't use any names, but they really like horses and stagecoaches, even if I was driving to work and I saw lower rates posted in the window, if I was to tell a client at my desk that lower rates existed elsewhere, I could be terminated on the spot, because that bank spent a lot of money to get those clients in that lobby and in my desk. My job was to sell them. And if I knew my rates were higher, well, I was supposed to just give extra good service. Well, and we should all be giving good service. So that should not be a distinguishing factor as professionals.
Right. Okay.
I can elaborate B and C if you want, but I don't want to give you too long of an answer, so I'll defer to you on that one.
Yeah, maybe just the quick 30-second explanation of both.
Sure. Well, so B and C, so B the broker and C direct lender, we can shop around in both of these platforms. So we imagine a horse race, and metaphorically speaking, we want the winning horse. We have multiple horses in the race. Brokers and direct lenders can both shop around. The difference between the two of them is that brokers normally will do the processing, identify the winning lender, and turn that file over to that winning lender to do the underwriting, loan documents, and funding, where you can see how we lose control of the file through 3 very important milestones, or a direct lender does all 4 milestones in-house. And so it's kind of like that, the old nursery rhyme, this one's too hot, this one's too cold, this one's just right. We can shop around and keep everything done in-house, so we have the same staff working on each and every loan file. So there's continuity and better communication.
Okay. Well, that makes a little more sense than actually. I appreciate you breaking it down. So I want to talk about, we're talking about going to a lender primarily to either purchase a property or refi. And obviously credit score plays into that. And, I'm a fan of Dave Ramsey, and Dave Ramsey, he's famously quoted as saying, building your credit is a myth we're suckered into because cash can buy stuff too, and the reporting companies got us so fixated on credit scores. But the reality is that if we are in fact without the cash and we need a loan, credit scores play into the type of loan or the cost of the loan or the rate of the loan. So can you speak on like the brackets of credit scores? Like what would be considered excellent, average, or below average?
Sure. Well, different loan programs have different influences on what will influence an approval or a rate quote. If we look at traditional Fannie Mae, Freddie Mac, conforming or conventional loans, they have tiers, as in TIER, credit tiers of every 20 points where your score ends up will put you into a different tier. So for example, you have a 680 to 699 tier, a 700 to 719 tier, a 720 to 739 tier, etc. Typically, when you reach 740, you're in that 740 plus tier, you're in the best rate quote you can get for most programs. Some programs will go with 760, and some will even give a little bit higher considerations depending on how high your score is. But I'd say when you're above 760, you're kind of in that walk on water phase when it comes to how you're judged by the banks.
Okay. And then just, talking to me like I'm a freshman in high school, my credit score is what creates my credit score as far as what are the major things they're looking at when they're creating my credit score?
Well, it's funny you mentioned high school because I've actually taught many graduating seniors at Scripps Ranch High School how this whole thing works. That was my way of, helping out with community service and teaching these freshly 18-year-old citizens the impact of credit and how not to make the mistakes that their parents and grandparents' generations have made. So you're really striking a chord with me there. So the main influences are payment history, which kind of makes sense, right? If you're not paying your small debts back on time, why should we believe you're going to pay a big debt back on time? But almost equally as important, when we isolate revolving accounts like credit cards, revolving means that you can charge them up, pay them down, then reuse that money on an ongoing basis. Where your balances are in relation to your limits, the percentage of utilization, if you want to call it that, is a major factor on how your credit score can be, how it will be impacted. And I get people all the time, hey, why is my score a 640? I never missed a payment in my life. Yeah, but you're maxed out on every credit card that you have. That's, but the good thing about that, though, is if they have excess cash, we can run software programs called what if simulators, where we can actually see if we can alter certain data on the credit report, such as paying down portions or all of certain credit card debts. We can do what's called a rapid rescore, and within about a week, change that score accordingly. So it's a case-by-case basis. I don't want to make any across-the-board claims, but we've had some amazing success with those.
Well, and I know just from working with you, I mean, you've done some of my refis over the years, and these are conversations we've had because, I'm in the real estate industry, but I'm a realtor. I don't work in the loans. I work with loans and people getting loans, but I defer to you for a lot of this info. And like, for example, if I have some high balances, like you mentioned, it's not automatic that I should go and pay those down. Because of what you just mentioned, right? I mean, would it be better that I speak to you before I go taking action on my credit? Because I could be depleting cash that is more important to you than the line of credit.
I'm so glad you brought that up. I really am. There are so many assumptions that are made when it comes to credit, and so many people are taking advice from some stranger on Google or some coworker who has no experience other than the house they bought 3 years ago, and ignoring a mortgage professional that does this for a living day in and day out. And Thomas, you know me enough to know that I'm not just putting in 40-hour weeks. I mean, this is my life, and I do study credit scoring algorithms. I understand how this stuff works, and we have access to these software programs that make us look even smarter when we can actually see how certain impacts are going to have. So with respect to all the assumptions out there, and even with respect to what would be common sense, right? Well, I'm going to pay this high interest credit card down first. My advice is, remember, when you are evaluated for a mortgage loan, it's a snapshot of how you look right now, not how you once looked in the past or how you might look in the future. It's how you look now. So my focus is really getting you as cleaned up as possible, so to speak, so that you get the best favorable consideration for both approval and rate quotes by altering your score at that time that we're actually seeking to obtain your loan. When all the smoke clears and you have those keys in your hand, yeah, go ahead and pay off the high or different debts if you wanted to. But our strategy is not so much And when we're creating that loan, we want to create that loan so you get the best of the best at that time. And we can still give you advice post-closing if and when applicable.
Well, see, and that's something that I stress to my clients, because one of the things I like working with you versus some of these transactional lenders that if you're not ready to go, they have no interest in you. But I can send clients to you that think they're ready, but it turns out financially they're not, but you can set them up with a plan as much as let's get the strategy that best serves getting this loan done. But then if there's other things you want to do to improve your situation after the fact, you're also a resource for that, hey, here's how we go forward, maybe with a new budget or a new plan. So with that in mind, and I know this might be another it depends answer, but when it comes to paying off credit cards, what school of thought do you subscribe to? Is it better to pay off the highest balance credit cards or the highest interest rate credit cards, regardless of balance?
Well, and I touched on that in my last answer, but to reiterate, we have software programs. Actually, let me back up just to kind of give a macro view of this. There's 3 different parties involved, all beginning with the letter C. You got people like you and I that are called consumers. We do business with creditors, whether it's Capital One, Wells Fargo, whoever it may be. And those creditors report about us consumers each month to credit bureaus. Of course, there's 3 of them. There's Experian, TransUnion, Equifax. And the credit bureaus exist to do 2 things. Number 1, they compile data from the creditors about us consumers. Number 2, they run all that data through this computerized algorithm and out pops a score at the very end of it. The algorithm's not going to change, but if we can change the data the proper way, we can predict the outcome of what the score is going to be with these software programs that we have access to through our company, Amerifirst Financial, that helps us get predictability, where if we altered certain, what we call trade lines, certain accounts, a certain way at a time where nothing else around us changed, we can predict with pretty good certainty what the score will be. And so it does help to go through me in that situation, because we have access to the data and we can see what will specifically move the needle, if you will, in terms of score.
Okay, no, that makes sense. So, I mean, that's another reason why before you go doing anything, it's good to talk to a lender that you trust, because you can create the best plan under your current circumstances. The other thing I want to touch on is, well, actually, I'm going to take a moment to remind people that when you're in the middle of a refi or you're purchasing a home, the last thing you want to do is go out and take out extra lines of credit or purchase anything like a car or the furniture. I had a client do this once. They were so happy they got an offer accepted. They went out and bought all the furniture for the house and just totally threw their debt to income ratio sideways. Can you speak on that a little? Because we've both been down that road.
Well, yes. And I think every seasoned loan officer has at least one story that firsthand about the client who bought the car while they were in escrow. And it's not a pretty thing. So when you get approved, we have essentially taken a snapshot of you and approved you based on nothing else changing. We're not done looking at you when we get you pre-approved. And I'll say that again. We are not done looking at you when we get you pre-approved. In fact, at the very end of the actual escrow period, when you're about to get loan documents or about to fund that loan, lenders do what's called a credit refresh. It's not necessarily an inquiry that hits your score, but it's another peek under the hood, if you will, to see if anything has changed. If we see a credit inquiry from Porsche Financial, that's not a good thing. You may have a $1,000 plus payment about to hit your debt to income ratio. And if we see that certain credit cards have gone up in balance, we have to recalculate the payment associated with that higher balance. Remember, all credit card payments are predicated on your balance. If we evaluated you when your Capital One account had a $1,000 balance, and now it has a $9,000 balance, well, we have to calculate the new payment. If that new payment pushes you outside the limits of your debt to income ratio portion of your approval, you've just nullified your approval. Yeah. So, and it goes beyond that, and I won't open up this Pandora's box because this could be an hour-long answer in itself. That also goes with changing your job, changing your profile. I had one nightmare story where somebody went from a full-time status, say, we'll just say making $25 an hour, to what she thought was a promotion, making $32 an hour, but she went from guaranteed hours to what they call per diem, or an independent contractor status.
Right.
She had no guaranteed hours. So we literally can give her at that point zero income.
Oh.
And I, that's a tough one. Of course I said, well, can you get your old job back? And, these are situations where I have people who've retired after they've gotten their pre-approval letter thinking that they were done being evaluated. So keep an open line of communication with your loan officer, no matter who you use. That's one thing that when you're using some of these .coms or these total strangers who you just heard a jingle on the radio for and you decide to call them and you don't remember the person's name, you're really running a risk by not having an open dialogue with your mortgage professional. And these are situations where assumptions can get the worst of us if we're not careful as consumers.
Agreed. A question that gets, it's funny how, when you raise kids, they're always testing the boundaries. Like, well, what can I get away with? And with no insult intended, sometimes clients are like kids, and they're, well, if I can't buy the furniture and I can't buy a car, how about if I lease a car? So they'll come up with all these different scenarios. But what you're talking about essentially is anything that's going to change the snapshot you took when you pre-approved them is a no-no until the loan process is complete and either the refi is done or the keys to the house are in your hand.
Correct.
Okay.
For the most part, you want to freeze your profile. And I really recommend, and again, this is not to be self-serving or promote just myself, but no matter who you end up working with, make sure you can go into their office, sit down with them, have a face-to-face conversation, look them in the eye. It's amazing how much more information gets disseminated during these face-to-face meetings. I had one yesterday. It was a 2-hour and 20-minute meeting. These are people who have bought in 4 different houses in the past, but they wanted to get kind of refocused on what the current guidelines were, the current protocols were. So there's something to be said for old-fashioned business. Shake the hand of the person that you're doing business with. Look he or she in the eye. This is the single largest financial transaction you're probably going to ever encounter in your life. Why are you going to a total stranger who's just a name on a screen? There's danger when doing that. Understood.
One question that popped in my head when you were explaining this last section was, is this predicated on somebody's income? Like if somebody, let's just say someone has a substantial amount of money, are they less susceptible to running out and buying the car or the furniture during escrow than the person that's a little more, check to check?
Behavior patterns are independent of financial. I'm sure there's people on dating websites that can really attest to that you cannot label across the board any one person based on any one factor. It really depends, I think, on coachability. If someone will just allow themselves to be coached during this time by a professional who will tell them what to do and what not to do and not make assumptions or kind of be defiant, if you will, as some children, in your previous analogy can be, just be coachable. But yeah, right. There's no economic status that prevents somebody from making a silly mistake.
Okay. We're going to pick up after the break. At this time, we're going to take a pause so that we can let our wonderful sponsor identify themselves. Jonathan, I'm going to turn things over to you.
Oh, thanks. It's been a fascinating conversation. So we're going for a break, folks. We'll be back in a second. We're coming back. Got my co-host, got a fantastic guest. What more can you ask for? Back to you, Thomas.
Okay. Before I press on, Jonathan, did you want to have any questions at this point?
Yeah, I've got a couple.
We'll go for it.
I'm going to say a dreaded word to you, Jason. Self-employment. Being self-employed. Got any tips, tricks, or just general advice about people that are self-employed trying to get a loan, a house loan?
Well, I appreciate your question, Jonathan. Once upon a time, that was a non-factor. And it seems like when the market crashed about 10-ish years ago, we as a lending industry in general, we turned our back on those people who are creating jobs for our society, who have the bravery and the gumption to go about it on their own. And I think we are absolutely failing as an industry, that population. So that's a tough one for me because I have a real soft spot for the entrepreneurial spirit. And so the real issue tends to come in 2 ways. Number one, until you have been self-employed for 2 full years, you're kind of invisible in terms of any credibility in the eyes of the lenders. And it's not me speaking about how I feel about you. It's how the lenders feel in general about a self-employed borrower, because statistically speaking, if a business is going to fail, it will do so in those first 2 years, or the first 24 months. So once you pass that hurdle, we generally want to see 2 years of federal tax returns to get an idea of what income you have. And what's tough about that is a double-edged sword. Our accountant, our CPA, tells us to write off as many expenses as possible.
Right.
It's not what you make, it's what you keep with Uncle Sam. So you may gross $100,000 in revenue, but have a very good CPA who finds $80,000 worth of expenses. And it's a good news, bad news thing. The good news is you're only paying income taxes on $20,000. The bad news is, guess what the lender wants to use for your income? $20,000. And here in San Diego, that's not going to buy you a whole lot. And of course, the 2-year window to look at you to see what your trajectory is. Are you ramping up, or are you kind of coming down? Did you have a good year followed by a bad year? Because they're looking ahead to see what they can predict in the future about your income and really what your ability to pay that mortgage back is going to be in terms of cash flow. Now, there are some programs that are going a little bit creative, if you will, and that's kind of my world. I love the creative nature. And I think Fannie Mae and Freddie Mac and FHA, which is HUD, and VA tend to not really have a lot of creativity, but we have certain programs, certain proprietary programs where we can use, for example, bank statements to show maybe 6, 12, 24 months worth of bank statements and isolate a focus on the deposit amounts within those bank statements to see what the true cash flow is. Okay. Now, they're not going to count transfers or things like that, but they're going to look at what the deposits are, and in many cases give you a pretty good favorable consideration to see that there's money coming in every month.
So they're watching the trend.
They are, but those programs they're not, the Fannie, Freddie, FHA, VA programs, so they're not going to be priced in terms of rates and fees as competitively. I always say the old adage with lending, even back in the old days, it's like Vinny and Rocco in the back alley. How bad do you want the money, right? So if you can't qualify for anybody else, you're going to pay, the big bucks. So the more we start going off the beaten path to find ways to qualify someone, the less lenders there are that are going to do those loans. And there's less lenders. Those lenders can command a premium for what they call risk-based pricing. And, they're still good rates. They're still good, but I just want to make sure our viewers and our realtors who are guiding those viewers are not looking at the billboard or the little jingle on the radio in terms of quoting a rate, and yet using that rate with someone who has the inability to qualify for the mainstream programs.
Yeah, I've got a quick follow-through question. Does the deposit, if you're going to put like a 40 to 50% deposit on the property, does that change the situation?
Overall, yes, but doesn't really change it with Fannie and Freddie. So historically, borrowers have been judged for mortgage loans on 3 categories in no particular order. Category 1 is the credit, which is the credit history, the credit score. Category 2 is the debt to income ratio, the cash flow. And category 3 is the loan to value, the equity, what we call the skin in the game. The more skin in the game you have as a down payment, the less likely you are as a borrower to walk away from that loan if you have a disruption in income or an increase in expense or some kind of hardship. Those people with a lot of skin in the game will just sell their house, pay off the loan in full, and walk away, and everyone's happy, and they move forward. So in the pre-crash days, in the 2000s and before that, if you had a very sizable down payment, the banks would more or less ignore your cash flow. Well, we all saw what happened 10 years ago when we didn't verify cash flow and people's capacity to repay these loans. We had a global meltdown, for lack of a better term. So now the hypersensitivity has reemerged in terms of cash flow. So I have people out there putting 40% down who can't qualify for a Fannie Freddie program, and that's a tough one.
Yeah.
It's hard telling someone with that kind of money that they don't qualify for a loan. However, we have creative methods, though. If someone has that much of a down payment, they generally have a lot of assets. There's different ways that we can use someone's liquid assets to overcome a deficiency on the debt to income ratio category of the qualifications. And again, that's a huge Pandora's box that we won't have time to open, and I won't have time to properly explain. But if you have borrowers, if you have clients who have a sizable amount of money in cash, but maybe they're retired, maybe they're, not with a lot of cash flow, they're not necessarily precluded from getting a mortgage loan. Have them get hold of me.
I want to piggyback on Jonathan's question because he brought up entrepreneurs and self-employment. But the other category I see people make assumptions that don't always go the way they think is rental property owners, where they want to use the fact that they have income coming off their rental property. But if they're newer in that business, that doesn't always help them. Can you explain the rule on income property?
Well, it goes back to those words, it depends.
Right.
So with the self-employed borrower, more often than not, we have a Schedule C, which is a profit and loss, where it shows up top the income coming in, followed by all the expenses itemized below, and then down below you see the net income. A very similar phenomenon exists for rental properties where we have a Schedule E, as in Edward. And so that's basically a rental cash flow statement where you have the rents received in total up on top, followed by all these different expenses that have gone in, anything from your mortgage interest to repairs that you may have made, in some cases HOA dues that you've paid.
Mm-hmm.
Now there is a book expense called depreciation, which is a beautiful thing for rental property owners because it's a gimme. Their roof is 1 year older, everything is 1 year older, it's 1 year less valuable. And so that helps you more often than not as a rental property owner reduce the income, the taxable income on that property. It's important for all of us to know as consumers and real estate professionals that we don't hit the borrower for depreciation. So we add that back. Sometimes that can be $5,000, $10,000 depending on the property itself and what's gone on. But that, my ongoing theme here is, let's not try to be amateur doctors and diagnose the patient by just jumping on some website or going by here today. Let's go to the professional. Not that I'm a doctor, but in that metaphor, go to the professional. Go to somebody who can really speak about each situation on a case-by-case basis. Assumptions kill our industry on all sides.
But I mean, in general, though, is it a general rule that you want to see that they've been collecting rent for at least a year or 2 years, or is there an average length of time?
Normally a year is the benchmark to show that, but even that is not necessarily going to be an issue.
Okay.
It really depends on the situation. I mean, if someone has a primary residence, we'll call it property A, and they're going to go buy property B as a rental, and property B has, let's say, $1,000 a month in rents received as verified by an appraiser via a rental survey as part of the appraisal.
Right.
We're going to give that borrower 75 cents on the dollar. So we're going to give them a $750 income, even if that's their first rental property with no history whatsoever. So I don't want to dissuade people from buying rental property because they're making assumptions that they can't qualify because they have no history. It's like applying for a job and no one wants to hire you because you have no experience. Well, how do I get a job?
Right.
So yeah, again, consult with a mortgage professional on that. But yeah, that's not necessarily going to hurt you in terms of getting a rental property.
Okay, cool. Hey, I want to shift gears a little and go to a basic, but I in 2017, I can't believe I'm still dealing with agents turning in pre-qualify letters versus pre-approval letters on my listings. And I realize this can be Pandora's box, but maybe let's just touch on like maybe 2 or 3 key points on the difference between a pre-approved borrower and a pre-qualified borrower.
Okay, so this answer is for California only, and realize that in different states, people they have different definitions for these. So in California, we have a pre-qualification versus a pre-approval. A pre-qualification is essentially tell me, don't show me. Go ahead and complete my online application, answer some questions verbally or on a handwritten application. And me as a lender says, well, based on what you told me but didn't show me, this is what you can do. Well, that'd be great if not for the fact that at some point we're going to have you show us. And
right.
If there's a deviation between what you told us and what you showed us, then every previous dialogue is nullified. And so as real estate professionals, if you, whether helping the buyer or the seller, are relying on unverified information and then crying foul when the lender doesn't do what you want them to do, with all respect, you're part of the problem. So a pre-approval is a full vetting of the borrower. In fact, I always say pre-approval is show me, don't even bother telling me. Let me figure it out. Let me
Right.
dig through your tax returns, your W-2s, your pay stubs, your bank statements, your credit report, and let me tell you what your debt to income ratio is.
Yeah.
Because we may have a different way of calculating your income, especially if you have commission or overtime or bonus structures. So it's absolutely imperative to get pre-approved. Now, a step further, and this is, I'll have some loan officers that may not like this, and I apologize if I'm offending anybody, but most loan officers try to pre-approve the borrowers themselves. The problem with that is that we have to wear two distinct hats to do our job correctly. Hat number one is that public relations hat. We want everyone to like us and send us
Right.
business. Hat number two is that risk assessment hat that says, well, no matter how much I like you, no matter how much this is the perfect house for you, you do not meet guidelines of Fannie, Freddie, HUD, VA, whatever it may be. And so you've heard the expression, seeing things through rose-colored glasses. A lot of loan officers say, well, yeah, we should be okay. Yeah, okay. Yeah, move forward. Go ahead and put that borrower in your car for the next 2 or 3 months. Spend countless times looking at 4-bedroom houses in La Jolla when all they can afford really is a condo in Mission Valley for 2 bedrooms. So,
All right.
so to solve that, we have an underwriter, an actual person who only wears one hat. They don't care about public relations. In fact, we don't even let them talk to the public because they're not always the friendliest people, but they know risk assessment. They dig through that file like a forensic accountant. So we get them involved early. And before my name goes on a pre-approval letter, before my signature is on a pre-approval letter anywhere, we've had a direct endorse or a DE underwriter pick through that file, run the DU or the LP, analyze back information channels that you may not even be aware exist, send me basically a book report on this borrower that I can then use to pivot to different loan scenarios when talking to the borrower and or the agent. If your lender's not doing that, you're running a huge risk, not only in your fiduciary responsibility as a real estate agent, but your reputation and your commissions in the future.
Well, let me just share too that, and this is through the pain of trial and error. And, I have been kneecapped by both those scenarios where you're showing property to someone and you're not showing them the right property, as it turns out, because they're pre-qualified, not pre-approved. And when they go from qual to approved, meaning stated to full documented, everything changes. And now all of a sudden, all that time you spent as an agent has been wasted. And you've done a number on their joy for the process, because now you've teased them with all these properties they're never going to afford. And on the flip side, I've been there where we thought everything was good. We're in escrow and underwriting comes back and says, hey, loan denied. And we're in escrow. And we've spent money on inspections and appraisals, and they can see their Christmas in that house coming up, and now it's just dashed. And I mean, and this is one of the reasons why I like working with you, because I've actually, as a listing agent, had to bring you in on deals to save the buyer from losing the house, and they're not even my client, but the agent that brought them in didn't do their due diligence on this borrower, and they're running around showing property that they shouldn't. But you've been able to save the day on occasion. I mean, I won't paint a pretty picture. Some of them we've tried really hard and it just wasn't going to happen. This kind of brings up the cross-qualify phenomenon that we're seeing probably since about 2007 in California, where a lot of listing agents are saying, hey, that's great, you want to write us an offer, but we're going to make you cross-qualify your buyer or borrower with our lender too, to make sure that Cousin Larry didn't just crank out a pre-approval letter that has no validity to it. Can you speak on that a little bit?
Absolutely. Well, the cross-approval phenomena really kind of originated in popularity with new construction, new builders. So you have KB Homes or Horton, whoever it may be, who says, look, before I customize this pile of dirt to your specifications, I want to make sure that you can actually perform on your loan. And so what's very, very important, and if you only hear one thing in this entire podcast out of my voice here, lenders, or nobody can force you to use a certain lender,
right,
to create that loan. Now they can have you get vetted, but if anybody on the listing agent side is saying, well, hey, if your client wants this house, you better do your loan with Susie at WeDoLoans.com, they are violating the terms of the California Bureau of Real Estate License. Let's mention Susie, in this example here, is violating some code in her NMLS license. So they can vet the borrower, but they can't make you get the loan through the borrower. Now, put on your buyer's agent hat for a moment here. It's a danger to have your borrower / buyer speaking with more than one lender, because we don't know what that other lender is going to say to that borrower. We don't know what competency, and we're just going to call her Susie here, how much she's going to give proper information or not proper information, and or she may try to steal the deal or make some outlandish rate quote just to pull them off the streets. There's a danger in that. So as someone like me who is working with a buyer, I can speak with Susie on behalf of our borrower. I can get authorization from our borrower to share certain documentation with that, what they call that preferred lender, and take that conversation on just by ourselves. That way our borrower does not get caught in the crossfire. I show the preferred lender what he or she wants to look at, and we're good to go. And on the flip side, I am that Susie on many occasions. In fact, many agents, including yourself, have asked me to look over buyers. And so I even had a website I created because I was getting so many phone calls on weekends, especially during football season. People want to know, hey, who are you? What do I have to give you? How do I get it over to you? So I created a website, crossapproval.com, with a checklist on there. And the reason I bring that up is my goal on that is to be really the friendly person. Hey, I'm not here to steal you from your lender. We're here to vet you in terms of making sure that you can perform if indeed your offer is considered. But there's a good way and a bad way to do most things. There's a lot of bad actions being taken on the cross approval side. So I'd say tread lightly and be aware as agents, and protect your borrowers or your buyers.
Yeah, I mean, that's my policy when in doubt. I have you talk directly to their lender. I don't want my client talking to them for exactly the reasons you stated. And one question that you brought up, new construction, because now I've seen the cross qualify enter the resale world since the depreciated market, because now people aren't trusting lenders as much as they did. But what about these new construction lenders that they have these enticements? They go, well, we'll do $10,000 worth of upgrades, or we'll paint your condo custom if you go with our lender, or you get the first year of HOA fees comped if you go with our lender. I mean, how are they able to do that?
Well, I'm going to be very careful and very diplomatic in this answer. We have a lot of builder relationships at Amerifirst Financial, and I certainly don't want to jeopardize any of those. But if you look at it from a revenue perspective, and just from a business, put on your business owner hat for a moment, no matter who you are listening to this. When a consumer goes to purchase a new construction, there are several different profit centers that are present. You've got the actual resale or the sale of the home, between what it costs to build it and what they're going to sell it for in the open market. That's a revenue source. You have the upgrades, those design centers. There's definitely some profit built in those design centers, as I'm sure you can imagine. You've got the lender, you've got the title and escrow companies. They all kind of circle the wagons and try to prevent any outside professionals from being part of the party, if you will. When you go to an outside lender, a lender that's not involved in the process of those wagons being circled, there's just one revenue center. And so sometimes you can take a loss on revenue center A and make it up on revenue center B. And, but also a lot of times it goes back to the usual, hey, we're going to mark it up before we mark it down.
Yeah.
Go to Nordstrom's or any department store, and hey, it's a 70% off sale. Yeah, the day before they marked up the prices by 50%, or whatever it may be. And so there's a lot of different ways consumers can be duped in a rate quote, and that is a Pandora's box. And I'm definitely not saying that people are doing the duping because they're in that new construction element, but I do, just as an experienced professional, been at this since 1991, I know how the duping occurs. I can help someone make an apples to apples comparison. And I see people all the time say, well, I'm getting a $5,000 credit from my preferred lender at the builder's office. Well, yeah, but they're giving you a rate that's going to be a 0.25% markup. With that 0.25% markup, that's $6,000 markup we could have in rebate for your same loan. We could use that to offset those costs, or whatever the maybe not 0.25%, but you kind of get the picture of that.
Right. No, you bring up a great point, because what you have to look at is what is this perk costing you long term? Is it really worth the perk? Is fresh paint on the wall worth paying a 0.25 point over 30 years more? So,
I think that's a great point. I think we need to wrap this up, Thomas, and then have a little bit of bonus content.
yes, I have a couple questions I'm anxious for Jason to answer on our bonus content. So we're going to be signing off the podcast audio portion, but join us over on YouTube, folks, for a few more minutes with Jason Gordon of Amerifirst. And speaking of our guest, I want to give Jason a chance to let people know how to reach out to him. So, Jason, will you sign off and give people some contact info?
Absolutely. Again, my name is Jason Gordon, Gordon. You can visit me at gordonmortgage.com. Let's make our compliance officers happy by me giving you my NMLS number, which is 259027. And if you want to email me, jgordon@Amerifirst, that's AMERIFIRST.US, like United States. So jgordon@Amerifirst.us. And my direct phone number is 619-200-8031. And I'm all over social media. I'm one of those few lenders that actually has their own Yelp page. So you can search me out, Jason Gordon. That shows you how accountable I am to what I do. I'm on LinkedIn as a Facebook business page, Jason Gordon Mortgage, Active Rain, you name it. I'm all over the place. Google Jason Gordon Mortgage, and you'll see plenty of ways to get a hold of me.
Nice. And we'll have your contact info up on the show notes as well. Jonathan, would you please let people know how they can reach you for MailRight?
Oh, thanks, Thomas. It's quite simple, folks. You can get me on my private Twitter feed. That's at Jonathan Denwood. You can go to the MailRight Facebook page. You'll find all the videos, conversations on there, plus some content that comes from MailRight. So you'll be able to view what we supply our customers. And you can go to the YouTube channel, like Thomas mentioned before. All the videos are there with bonus content. It's getting a lot more views than it used to. They're the main ways you can see more about the show and myself. Thomas, back to you.
Thank you, Jonathan. And I'm Thomas J. Nelson, residential realtor here in beautiful San Diego, California, where I'm never too busy for your referrals or to help you as a resource. So if you want to network, or if you have Q&A, or you want to do the old-fashioned thing and buy a house and join the American dream, I'm here to help you do that. You can find me on social media, thomasjnelsonrealtor.com, or I'm old school, you can call me. I actually answer my phone at 858-232-8722. Thanks for joining us on this episode, and we look forward to your comments as well as your downloads. Please download our show. As you comment and download our show, it lifts our popularity and gives us the opportunity to invite great guests like Jason Gordon, because they see the value in our show and our wonderful audience. We're going to jump over to YouTube and some bonus content now, so we hope you join us there, folks. But if you're signing out on the audio portion, we'll see you next week. Thank you, and bye.
Thanks, folks.
All right.
Can I ask a question?
Please.
So, you know, after the Great Recession, you got a lot of people now as a percentage of the lending community that haven't got great track records now, or their track record was quite good until the recession, and because they lost their job, they lost their home. How is the industry coping with the realities of the loan market now?
Well, again, whatever happened in the past, obviously is part of your history, but we're evaluating you more on where you are now, and of course, where you're going. So we saw a lot of people during the market crash go from, full-time to part-time, income dropping, dual income to single income. We saw people falling behind on their credit, equity. Think about your home's value for a moment. I mean, a lot of property values dipped. And so during that time they dipped, you may have been unable to get financing during that time. But when those people saw their values come back up, now they're back in the game. So that same theme occurs with some of the other issues that may have prevented someone from getting a loan in the past, whether that be credit history at the time, whether that be income or cash flow. Maybe they paid off some debts. Maybe they got an inheritance. Maybe they had put 24 months of on-time payments in the most recent profile to divert our attention from the bad credit they had previously during that time. So one of the best things about credit is time does heal all wounds. So you can kind of get back on your feet, dust yourself off, and move on, and not be haunted the rest of your life over some credit issues.
So I wanted to ask you a question about Jonathan's question's a good one, and one of the things that people keep bringing up to me, which is kind of coming off of Jonathan's question about the great depreciation we went through, is it appears we're in another bubble. That's what people keep saying to me, and and my simple answer is, look, we were in a bubble last time because of several factors that do not exist right now. At least what I'm seeing in our market is it's a very supply and demand driven market. There's a law of gravity, there's a law of supply and demand, and we are following that law. But there is something that you brought up when we had we went to lunch last week and we were talking, and you brought up an interesting point about the Amazon effect on our market. And I wanted you to speak on that because I thought it was an interesting point of view, not to create any panic, but I mean, it's food for thought.
Well, the panic might be real. I don't have a crystal ball, but so when you go back to about 10 years ago, when you look at kind of the epicenter that caused this global collapse, or whatever you want to refer to, the mortgage meltdown, with the housing crisis, a lot of it came about from bad loans. And so at the time, a lot of bad loans kind of blew up on people, right? You had, negative amortization, you had interest only, you had a whole lot of just exotic loans. And of course, lenders not verifying the capacity to repay loans with stated income or whatever it may be loans. Eventually, the ripple effect to that caused a lot of job loss. And so the average homeowner has a family budget, and that family budget can be dissected into two categories: the needs and the wants, right? I need to pay my mortgage. I need to have food on the table. I need to pay my insurance. I need to send little Johnny to school every day. The wants, well, gosh, I sure want to go on vacation. I sure want that Ford, or that Cadillac Escalade. I want that plasma TV, or whatever, whatever the Joneses have next door.
Right.
A lot of those industries that are predicated on the wants saw revenue dry up because people could only afford to pay their needs and not their wants. And so that created even more unemployment because all those industries that were catered toward people's wants dollars weren't able to sustain their business plan. So fast forward to the current day, because we managed to get past all this. Look at the last 10 years. I mean, we managed to get back on our feet for the most part. I mean, I'm not going to get political here. There's always going to be some tug of war over how far back we are, but people are back to work. Unemployment figures are down. But my concern moving forward, and this affects all realtors, affects all lenders, it affects a lot of different other professionals out there, is what I call the Amazon effect, where we're starting to see industries get revamped via technology.
Right.
Why should we pay this human who calls in sick, who has their own personal and emotional issues and baggage at some times? We have a computer that can do that same job for a lot less money, never calls in sick, never has an attitude or a bad day. And I mean, we're hearing about driverless cars now. I mean, how many jobs will that actually eliminate if indeed this does come to fruition? And let's not make any assumptions that things aren't going to come to fruition. Look how far we've come in the last 10 years as far as technology.
Yeah, we're in it.
To bring this kind of closer to home, and I think you'll appreciate this, Thomas, is, for the longest time, realtors have kind of felt like, hey, we're immune to any issues when it comes to the Amazon effect because, everyone needs to talk to a realtor, and how hard we work and all the things we do for our clients. But look what's going on with Zillow, with Redfin, some of these bigger companies out there right now.
Yeah, with Amazon itself.
Well, Amazon itself, I'm hearing about potential of Uber Realty. I mean, I don't know when this is going to stop, but I do encourage all real estate professionals, and I don't work for this company, and it's not necessarily a plug for them, but there's actually a local company here that's helping realtors understand what's going on right now. And that's a company called the Career Compass. And if you go to careercompass.com, I've been affiliated with them for many, many years as a sponsor and a speaker. And again, some of you may have heard me or seen me throughout the years. I address over 1,000 realtors in that capacity per year. The head of the Career Compass, a guy named Wellington Pendel, which they call Beef, as in Beef Wellington. Insert your own jokes there, Beef. Does these workshops now where he's helping agents understand not only what the impact could be, but how as realtors we can band together to have talking points to the consumer, to help them understand the dangers of selling their home without an agent, the liabilities that could be there, the lower prices, the other things that go into that. And selfishly, as a lender, I'm counting on you realtors to stay afloat and keep us lenders in the game. Because technology is already there to evaporate a huge portion of my market share with automated underwriting, with rate quotes online, with uploading documents online, with dispatching notaries and appraisers out to people's homes. I had a very sobering conversation about 3 years ago with a mortgage market expert who said, Jason, the technology is already there to replace you, to make you a travel agent. All that hasn't caught up yet is consumer acceptance.
Right.
But once the consumer accepts that, you mortgage loan officers are in danger. And so I'm relying on you agents, plain and simple, stay relevant and stay influential and not let us go away, because if we go away, you're next.
Right. I mean, there's a domino effect, because then it affects title and escrow and all the peripheral services. But, it's funny because, I mean, as the saying goes, there is an app for that. And there is an app for mortgages. There is an app to let two homeowners or a buyer and a homeowner conduct a deal without an agent. That exists now. So it's on us to say, look, the app can't do what I do, but you got to show it. You got to demonstrate it. You have to be. I think the number one thing we need to do. You always hear the USP. What is your unique selling proposition? But how does that benefit the consumer? And why does a consumer then make a decision to still work with the experienced agent over the easy app? And that's for mortgage and for real estate.
Yeah, as an outsider, but somebody involved in technology, I think agent really just has to prove their value, and I think you do prove that, Thomas, quite regularly on the show and by what you do in your local community. Other agents probably don't, and they're probably going to face problems. And but I just want to go back. I don't want to go into politics, but there are basic facts, and basically the unemployment figures in the US are totally manipulated. And the reason why they're totally manipulated is that if you had that level of official unemployment, you would have wage inflation. You would have major wage inflation, and there is none. There's no major wage inflation. Why is that? Is that as a percentage of males and females that should be part of the workforce, you've seen a dramatic reduction in the percentage of people actively involved in the American workforce over the past 8 years. And you've got over nearly almost 14 million Americans on long-term invalidity payment. And that's been the main way that people that no longer feel that they can contribute anything to the economy have found a way of still sustaining themselves but not finding employment. And they're just basic facts. Politicians from the left and right can do with those facts as they like, but they are the basic facts. And I think the other factor is I actually don't totally believe that the mortgage industry was the reason for the collapse in 2008, 2009. I think it was the public face, and it had some element. But fundamentally, I think you only have to change one word to understand what we're dealing with, and that word is, we say the finance industry, it's actually the debt industry. The only way the finance industry can grow is increase either public or national debt. And there's only so much debt anybody or any country or any state can sustain. So its own destruction is really inbuilt into its own business model, really, if you understand. Am I making any sense there, Thomas?
You are. I mean, well said. I'm not going to jump on that because that's another Pandora's box. And since we're coming up at the end of our show, I'm just going to let that stand on its own merits. And I want to hit Jason with one last question. This is what we call the sidestep and segue, Jason.
I'm impressed. So that was a champion move on your part, Thomas.
He can move quick. He's a quick mover.
There's an expression in sales that says you can be a greased pig in a round room. No one can tackle you if you know what you're saying. So that was very greasy piggish of you, Thomas.
Oh, thank you. It wouldn't be the first time someone called me a pig.
For the record, I was not calling you a pig, but we'll move on that one.
Well, and
Hulk.
and what we're alluding to here is that the relationships. And I stressed at the beginning of the show that first and foremost, you came into my business as a professional. A friendship personally grew out of that. But initially, we were networking partners and we were professionals that worked together. And over the time, we've had lots of conversations, and it still makes me shake my head that I understand the public commoditizes you and they commoditize us, but they hammer on lenders, I think, worse than realtors. But what surprises me is I'm going to keep this politically correct. Not every realtor treats you like a partner in their business. Not every realtor looks upon you as someone equal to their value. And that surprises me because to me, I can't do my job without you, and I rely on you to be the expert you are, and I don't try to fill those shoes. I defer to you to handle that portion of my client's needs. But not all realtors treat you that way. I mean, and rather than go down that rabbit hole, I just want to ask you this question: like, what are maybe one or two things that you see that are issues between lenders and realtors that are really preventable? They're unnecessary hang-ups that maybe that you can see a better way of doing business together and improving relationships.
I appreciate the kind words, and I appreciate the question a lot. I hate to answer a question with a question, but if I can ask you a quick question
Sure.
and then carry on with my answer. Do you feel that all realtors are exactly alike? You know what?
Oh, good
the
Lord.
laughter was my answer. Okay. So something told me that was going to be your reaction. So folks, not all lenders are alike either. Okay.
Right.
The barriers to entry to become a realtor are very low. The barriers to re-entry are even lower. They're not much higher for becoming a lender, especially when a lot of lenders can come in through the banking world without a college degree, go from a bank teller to a new accounts rep to suddenly they're selling mortgages. Okay. So it's very important. I mean, we have the same license. I've been licensed with, at the time, the DRE. It's now the Cal BRE. I have a salesperson's license and a broker's license. I guess brokers takes over the salesperson's at some point. But
Right.
We have the same license. We have a fiduciary responsibility to those who we serve to seek the highest and best results for our clients. And if you, as a real estate professional, are making careless assumptions that all lenders are alike, that we're all a bunch of swap meet vendors all selling the same trinkets in our stands, and having lenders get shopped around left and right and just being treated like this commodity salesperson, not only are you disrespecting the lenders, but you're failing as a real estate agent to perform your duties. And I don't mean to come off harsh, but I'm on these Active Rain blogging, chat threads. I see things online. I go to these real estate seminars or, whatever it may be, and I hear the way some of you talk about lenders, and it's not all of you, but those of you who are doing it, feel free to, go to the sink, splash some cold water in your face and realize this is not how you should be conducting yourself. We are not a dime a dozen. We perform a very valuable service with a tremendous amount of variables that cannot be controlled. Anything from interest rates to housing values, to government regulations, to approval guidelines, someone's credit history, the way they derive their employment, their income, the debts they have, how their funds to close are arriving in escrow. It goes on. I mean, condo issues, you name it. We go through a lot of very high-end level analysis and having to be able to pivot on a dime when adversity pops up its inevitable head. When you're treating us like commodity salespeople and having your clients shop around, guess where your client's going to end up? To these companies that are advertising on their radio, on the television, on their computers, or their tablets. And guess who's answering that phone? A transactional salesperson who is being given 5-10 leads a day. You do the math on how many they're getting per month. They're being told to sell every person best they can and sort it out on the back end. Well, if you're trusting your client's earnest money deposit, their future, their half-packed bags in their home that they're about to depart, over somebody who's 200 miles away answering phones in between college classes because you told your client to shop around, shame on you.
Yeah, I think that's so well put, actually. Thank you for saying that. And I think it's also people that buying or selling their home. Obviously a strong personal recommendation is fantastic, but even if I get a strong personal recommendation, I still check over that person on the internet. I look at their website. I look at their, what people are saying about them on the reviews they get, and I understand those reviews can be manipulated, but because I read a lot of reviews, I know straight away when that most of them are genuine or they're just been put up by some agency. And I think a lot of professionals really need to wake up that they are being checked over quite a lot. And if I was buying the biggest financial obligation in my life, which is normally somebody's home, I'm going to check over the person that's representing me, and I'm going to check over the company that I'm getting the loan from. I'm just going to do it. And I don't think I'm the sharpest tool in the box, but I don't think I'm the bluntest, and I don't think I'm that different to a lot of people.
Well, Jonathan, I'll share with you, kind of as Jason put to me, are all realtors alike? Not all consumers are alike. You'd be shocked at how many just go with the first person they come across. As Jason was saying, there's a lot of catchy advertising and misleading advertising that we didn't even get into, but there's legitimate ways that they can make themselves appear in the best light, and they're actually not being dishonest, but they're not telling you the whole picture. No. Because the bottom line is, as you said, this is a fairly large investment, and it's an emotional investment as much as a financial one. So you're going to be with some people for quite a few weeks. Depending on the market, a few months, and you want to align yourself with people that are good in both competence and character is the simplest way to put it. And I think it warrants doing a little bit of due diligence, and certainly a personal recommendation to me trumps Googling top lenders. Jason, any final thoughts on that? I know we got to wrap things up here.
Sure. A very simple, easy final thought on that is a website, we may have heard of it, called Google. Yeah. Google the personal name of the loan officer with the word mortgage after it. And if nothing pops up, there's a lack of accountability being placed. First of all, I think every loan officer should have the courage to have a Yelp page. You go on Yelp.com, you punch in that person's name and the city that they derive in, you should see a page dedicated to them. The fact of the matter is most of them will not do that because there's too much room for being scorned online over a rate quote, over a closing cost quote, over closing a day late or missing a contingency.
Can I just say, Jackson, slightly interrupt there, not being rude. I just want to point out to people is don't be scared, because I speak to a lot of people and they're scared that they're going to get bad reviews. Yes, you are. You are going to get people. You can't please everybody.
That's right.
But if you got 10% bad and you got 90 good, most people will realize you're above average. You're doing your job to the best of your ability. So you shouldn't be scared, should you?
No, we look at hotel reviews all the time when we travel, and we'll look at the negative reviews, and I'm smart enough to see, okay, this was a very isolated complaint. This is this guy's hang up. This isn't I don't think the average person would have the same hang up. So you know, or you can see like somebody didn't get the rate they thought they were going to get, so they, you know, they blast it. But I think an educated person can discern somebody having a tantrum versus a legitimate complaint. To Jason's point, I mean, you know, Jason and I are both on Yelp. That's how we both get some of our business, actually. Yeah. And we dare to put our reputations out there because we stand by our reputations.
Absolutely. Absolutely. And it goes down to personal and professional accountability. When you are hiding behind the name of the company that you work for, and I'm not going to mention names, it's not important right now, but we know the names of the companies on these commercials. And a lot of these loan officers that work for these companies define themselves by the company they work for. You can't find them on LinkedIn. How do you not find someone on LinkedIn who's helping you with the single largest financial transaction of your life? I'll leave it at that. I mean, really.
I think that's a good one to end it on. All right, Jason, for the benefit of our video audience, I want to give you another opportunity to sign off and let everyone know how to get a hold of you.
Absolutely. Well, thanks a lot for your time and attention, folks. I appreciate the opportunity, both Thomas and Jonathan. I really do appreciate it. It's an honor. My name is Jason. The last name is Gordon, Gordon. I'm a branch manager and senior mortgage loan officer with Amerifirst Financial. My offices are based here in San Diego in both Carmel Valley and Mission Valley. I can be reached at gordonmortgage.com or jgordon@amerifirst.us is my email address. That's jgordon@amerifirst.us, like United States. And my direct phone number is 619-200-8031, or use that little known website called Google. Punch in Jason Gordon Mortgage and pages will appear. And if you're a real estate professional and you have not gone to the Career Compass yet, go to thecareercompass.com, register for one of our upcoming trainings. There are trainings right now to help you understand the impacts of the Zillow and Redfin effect on your future as a professional. If you don't see one in your area, contact me directly. I'll get you on a list. We will be bringing a few different seminars over to San Diego in the next coming months. There's over 90 attendees at one of them on a Monday afternoon and one's inside of one of the offices. These are packed. I'd say they sell out, but of course there's no fee to come to these. But be educated, be smart in your industry, look ahead, not just at what's in front of you. If we're going to be career professionals, we have to look ahead at all times. And these are very pivotal ways that we can get the information and make sure that we do thrive when our competitors don't.
Well said. And, you know, I will share that I'm a member of the Career Compass. And in addition to everything that Jason mentioned, it's also a fun and very easy way to renew your real estate license. Jonathan, how can people get a hold of you?
I was really easy. Like I said, you can get me on my Twitter feed at Jonathan Denwood, or you can go to the Mel Wright Facebook page, and all the stuff that we're involved with is on there. So I think I'm going to wrap up things up. Jason, it's been a pleasure talking to you. I think we've provided a lot of value in the discussion, and thank you for coming back, Thomas, from your Buffini loving. You look rested, and you were missed last week, and he's off again, so I'm on my own next week, folks, but I think I'll be able to cope. So we'll see you next week, folks. Bye.